Good day, doctor. My name is Dong Zifeng. Metric number is 299694. Today, I will present about the effect of internal and external factors on the credit risk of UOB Bank Singapore from the year 2014 to the year 2023. First of all, UOB Bank Singapore has faced persistent credit risk challenges in recent years, largely due to an uncertain economic environment. In the third quarter 2021, the bank saw strong financial performance with higher net profit, boosted by improved asset quality and loan demand. However, volatile interest rates, uneven regional economic recovery, and the regulatory changes continue to pose significant threats. These factors raise the risk of loan defaults, especially in sectors hit hard by the pandemic. Despite efforts to diversify through digital banking, credit risk remains a major concern for UOB's core lending operations. There are three research objectives that we should study. First, to identify the internal or company-specific factors that may have an impact on the credit risk of UOB Bank Singapore. Second, to identify the external factors or macroeconomic that may have an impact on the credit risk of UOB Bank Singapore. The last one is to identify the potential internal and external variables that affecting the credit risk of UOB Bank Singapore. There also have three research questions which are: is there any relationship between the internal factors and the credit risk of the UOB Bank Singapore? The second is there any relationship between the external factors and the credit risk of the UOB Bank Singapore? The last one is there any relationship between the credit risk of UOB Bank Singapore and internal and external variables? Next, we move to the literature review. First of all, Saunders and Allen 2010 mention credit risk is the possibility of a borrower's failure to repay principal or interest as agreed upon, which could have an adverse effect on the lender's financial situation. The next one, Michigan F and FS 2007, bank loans are financial assets produced when banks extend credit to borrowers. They are a contractual commitment to repay money plus interest. They contribute significantly to the creation of credit and are a major source of bank revenue. For the debt to equity ratio, Abuladaka 2023 mentioned the one important indicator of a bank's capacity to service its debt is its debt to equity ratio. The higher ratios may indicate a higher level of credit risk. The Diamond and Rajan 2000 mentioned bad liquidity management, especially neglect of short-term commitments, usually aggravates credit losses and raises the insolvency rates. For the interest rate and yield curve, Estrella and Mishkin 1996 mentioned an inverted yield curve where short-term interest rates exceed long-term rates has been a strong forecast of oncoming recessions. The last one, market risk and employment rate, Extit and Peterson 2019 mentioned an elevated unemployment rates generally imply economic distress, which can heighten uncertainty and intensify market risk, including stock market volatility and credit spreads. For the methodology, the study will analyze the relationship between UOB Bank Singapore and its determinants using data from its annual report from 2014 to 2023. This report's dependent variable is credit risk, while the independent variables are internal, external, as well as internal and external components. The study uses financial data from UOB Bank Singapore's annual reports to evaluate credit risk. The basic statistical method used is ordinary least squares OLS regression, which includes multiple linear regression using SPSS version 26. For the statistical technique, there are three models which to evaluate the credit risk. The first one, model 1, is influence of the internal factors on credit risk. Model 2, influence of the external factors on credit risk. Model 3, influence of both internal and external factors on credit risk. Based on the descriptive statistics table, equity multiplier has the highest mean, which is 48.55%, while the market risk is the lowest, which has only 0.05%. For standard deviation, the ratio of interest income to annual average loan has the highest standard deviation, 1.13%, while the market risk is also the lowest, which has only 0.014%. The correlation table shows the strongest correlation is the risk-weighted assets to total assets ratio with the value of negative BWRRK3073 is the most significant effect to credit risk, while the yield curve is the weak correlation with the value of negative 0.229 has no significant effect credit risk. Based on the three model summary tables, the model 3, which is internal and external variables, shows the highest adjusted R-square value, which is 1, has the strongest linear relationship to dependent variable, which is credit risk. Refer to Woodridge 2015, since values much greater than 2 imply the presence of negative serial correlation. A W-Watson statistic value of 3.073 indicates a negative autocorrelation in the residuals. Based on the three ANOVA tables, the model 2, which is external variable, is the most significant effect to credit risk with the p-value of 0.032. Based on the three coefficient tables, the model 3, which is internal and external variables, is the most significant effect to credit risk because all the p-values from the table are less than zero point 0.1. In summary, UOB Bank Singapore's credit risk is not entirely well managed due to significant impacts from both internal and external factors. Internally, elements like debt ratios, capital adequacy, and liquidity play a key role, while externally, interest rates, inflation, and unemployment create added pressure. These factors affect both the bank's ability to handle defaults and borrowers' ability to repay. Despite this, UOB has shown resilience through strong risk assessments, responsible lending, and proactive measures during crises like COVID-19. This study also highlights some key recommendations in UOB's credit risk management. The bank still relies heavily on traditional benchmarks like debt and capital adequacy ratios, which may not fully capture modern credit risk complexities. Additionally, its current risk framework is less effective in anticipating unexpected macroeconomic shocks. Moving forward, stronger stress testing and scenario planning are essential for the bank to maintain its market leadership and address emerging credit challenges. That's all for my presentation. Thank you so much.